You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. Before we begin today, I do want to remind you that there is a rockin' and rolling investor club going on right now. If you are an accredited investor, you should get involved because we are getting some just really outstanding potential deal flow. You know, huge discounts, blood is flowing in the streets, and it's finally our opportunity to, take advantage of that. And so don't hesitate if you're serious about actually investing in times when, there's distress out there and buying at discount prices. Now's the time to do so. You've got a descending rate environment upon us. It's, all the right things. This is what happens. Generations of real estate investors will tell you this is the time when you want to try to buy assets that make sense, that are at a discount. If you're an accredited investor, make sure you go to wealthformula.com, sign up for our investor club, get onboarded ASAP. Now, speaking of apartment buildings, let's talk about underwriting a little bit. Okay, now every time we underwrite a new asset, we build models, right? That's what everybody does in this business. Modeling an apartment building, though, on a spreadsheet is not like modeling a house. The price isn't just what someone thinks it's worth. It's determined by a lot of things, net operating income and cap rates, and of course, cap rates, which are heavily influenced by interest rates. Modeling for apartment investing also includes measures of job and population growth in a given area and the impact of new construction. Suffice it to say, underwriting major real estate assets is a pretty complicated affair. Now, the funny thing is that even the inputs we use in our models are based on, really, frankly, on other models. So essentially, you have models based on models, right? So that kind of gives you sort of an idea of where this goes. For instance, central banks, they're the ones who are using models to manage inflation by predicting the effects of monetary policies and by increasing and decreasing interest rates, right? And then you have the corporate world. They're forecasting stuff. They're optimizing their prices. They're managing their supply chains. These variables, again, all affect our underwriting models in real estate. Therein lies the limitation of modeling. That is, it depends on the accuracy of the input data itself. So models are really only as good as the data that's fed into them. Inaccurate or incomplete data can lead to, misleading results. So if models generating the numbers for your models are off, then, your model is going to be off as well. So why do we do it if that's, if it's so complex? Well, the reality is it's the best that we can do. And most of the time, in my experience, the modeling at least points us in the right direction. Now, on this week's episode of Wealth Formula Podcast, I interview a guy by the name of Doug Howarth. He is all about modeling, and he's developed a unique approach to economic modeling called Hypernomics. And he's going to share his insights on Hypernomics and how it can potentially uncover the hidden dimensions in markets and provide deeper understandings and strategic advantages to investors. So listen to the show. Let me know what you think. We'll have that right after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Doug Howarth. He, in 2011, formed a company called Hypernomics, who show their customers how to take advantage of this concept of hypernomics. Hypernomics Incorporated has worked for NASA, United Technologies, Lockheed Martin, Raytheon, and among others. Along with two of his other hypernomics colleagues, he was awarded the U.S. patent for multivariable regression analysis on this particular type of intellectual property. It's the world's first software designed to deconstruct markets into their 4D structures. He's the author of Hypernomics, Using Hidden Dimensions to Solve Unseen Problems. Doug, welcome to the program.
Dr. Joffrey, thank you so much for having me on. I really appreciate it.
Yeah, so this is a fascinating topic, especially for a lot of the, we have a lot of math nerds in this audience. So it's, I don't know, I put myself sort of borderline math nerd on there. I got myself, A's in calculus, but ended up in medical school. So let's talk first and foremost, just introduce this concept of hypernomics to everyone.
Yeah, hypernomics, that's how we pronounce it, is a concept that looks at markets, as the name implies, in 4 or more dimensions. So the prefix hyper means existing in more than 3 dimensions, and nomics from nonomy means a field of study. So hypernomics is a field of study that looks at markets in 4 or more dimensions. And the easiest way for scientific types to try to reduce this to what they do is to relate it back to a little vignette I had for myself just a few months ago. It was after I wrote the book. I got done running and I went up to this parking lot, and I was bent over, heaving real hard, and I saw this little reddish-black rock ant. And I said, Dr. Richard Feynman used to study ants, and I said, I'm going to study this guy for just a couple minutes. And so I noticed this guy starts to make this little counterclockwise turn. He's going in fits and starts, and he's stopping, but then he keeps going counterclockwise. And eventually goes around 360 degrees. And he's out a little bit further than he started. Then he goes around another 360 degrees. And he's out further still. And I go down a little bit closer, and I notice that when he stops on these little fits and starts, he's at the top of a little pebble, so it's raising his eyesight out. And I realized in an instant that this ant was doing reconnaissance. So I raced home and I typed in ant reconnaissance, boom, and hit it into a search bar. And sure enough, these ants that have been around for 140 million years do reconnaissance. And what they do, back to your real estate theme here, is they look for new places to live that have a certain amount of floor area, a certain height. They don't like it to be too high, too low. It's got to be very clean, and they want to be away from the neighbors. And so it turns out that in all markets, we can actually measure what people like on one side, these variables like in the case of a house, the square footage, and maybe the size of the lot and how new it is. And then we can compare that to what we can afford as the price goes up. As the price goes up, people afford fewer. And as the price goes down, people can buy more. And so Hypernomics recognizes that there's this coordinate system that's existed since the beginning of time that starts at 0 and goes out in every direction from that. So in a 4-dimensional system, for housing, it might go square footage this way, lot size this way, and then price. And then on the other side, as we call this would be value parameters. And then on the demand side, you'd have the price and you'd have the quantities here. And so the higher the price, the fewer that are being sold, and as the price falls, more and more are being sold.
All right.
And so Hypernomics looks at how these forces interact with each other so that you can make the best decisions.
So effectively, I mean, in a way, isn't it essentially economics just with more dimensions? I mean, that's pretty much it, right? I mean, because instead of looking at, let's say the concept or the, just the theory of supply and demand, those are just two. In that situation, you've really just got two variables that you're looking at. And here what you're saying is, well, what we really need to look at this is in multiple variables, not necessarily 4, but it could be as many variables as you can plug into the system.
Yeah, exactly. What we try to do with this then is we try to figure out how many variables are actually impacting something. So in the case we use this for stock analysis, for example, we've created our own fund, not open to the public. It's been out now for just short of 4.5 years. And as of yesterday, it's doing 50% better than the S&P 500, but only getting stocks from the S&P 500 and only going long. And what we do there is we go out and pull the variables in that we think impact the price. And so return on assets, book value, dividends per share. And then we compare that to this. We get a plane that describes what the average of all those stocks would be. And then we look for the stocks that may be undervalued relative to the average in that group.
Mm-hmm.
And we might run this several different ways then to sort out which ones are the best ones. And if a stock keeps coming up undervalued, and then we go out and we do searches to see, well, is the company being sued? Have they lost their chief executive? Things like that are not picked up in the balance sheets. And then if it passes all those tests, well, then we might put it into the buy category.
Mm-hmm.
And then we buy it at a certain point according to an algorithm that suggests that it should accelerate in its price for a while. And then importantly, we sell it while it's still in the acceleration phase, before for all you calculus nerds out there, before the second derivative turns negative. We want to sell it before it starts to decelerate. We've used this technique now for, like I said, for nearly 4.5 years, and we're doing quite a bit better than the S&P 500.
Uh-huh.
So.
Are you using, what kind of technology are you using? Are you using machine learning? What types of technology that are going into this, or is this just old-fashioned software?
Well, it's not old-fashioned software. We
Yeah.
just built we built our own 4D system. So
Uh-huh.
our 4D platform that is that
Uh-huh.
patent over there over my shoulder is for what we now call Hypernomica, which is
Uh-huh.
the software that pulls in a whole set of variables. We select a dependent variable, and then we match it up to a bunch of independent variables. The software self-ranks the impact of the variables, either positive or negative, in a orderly fashion. And then we select the variables that we think, according to the rank, might impact the dependent variable. And then if they pass a variable suitability test, again, for your software nerds out there, would be a p-test, which basically says the chance that this is null is less than 1 in 20. If it passes the p-test, then we said we might include it. So we keep adding variables in until we start to reduce the error term. As we reduce the error term, we start to get more confidence that the price we've picked is a good one.
How would you use this, or, I don't know if you have used this necessarily in real estate markets. Now, I should preface this saying, we already use, and, whenever we're analyzing and underwriting opportunities, we're already using lots of variables. We're not just looking at.
Sure.
So maybe you can, if you have some examples specifically to real estate and how, maybe you're using that, or you think you could use that, that'd be interesting.
Yeah, we have a very good example. I think one of the best ones I like here in the United States is that back in 2010, this developer built this property that he called Stone Mansion in Alpine, New Jersey. Now, Alpine, New Jersey is the easternmost part of New Jersey. It's on the Hudson River. It's about 15 or 20 miles north of Manhattan. And he made it, it was a fabulous property, had tens of thousands of square feet. The lot was big, and he priced it at $69 million. That's a lot of money. In fact, it was more money after we worked out the value of the square footage and the lot size and how new the houses were. It was more than twice what the market would bear according to our equation. And so he had it in the market at $69 million in 2010. 8 years later, he dropped it to $39 million roughly, and it still held, and it finally sold back in 2023 for just about the price we predicted. So had he had this software and applied it to his product, the house was never occupied in that whole period of time. So he was holding this, by the time it sold, he was holding this $25 million asset for 12 years, not making any money on it at all. He had hoped that some one person would be outside the distribution. And of course, occasionally that happens. You might find somebody that really likes it. They're, right at the end of what you could predict would happen there. But that didn't happen.
Right.
Now you take the same kind of case and you plop it over across the pond, as we like to say, into the UK. And the builders of the Shard. Now the Shard is that pyramid-shaped building in London that went up a few years ago. And it's a very spectacular building. And they were touting it as something that the financial district would like. And, it's very beautiful, but it's on the wrong side of the river. It's not where the financial district is. The financial district is north of the Thames, and the Shard was south of the Thames. And so they attempted to price these very beautiful apartments that they had and the offices as if it were in the financial district. And what they discovered was they couldn't sell them very quickly. And so the place lay not filled up for about 3.5 years because they had overpriced it relative to where they were. So the whole real estate thing of location, was hugely important in that part. And they discounted it to the point where they were left holding the bag for several months with real estate they couldn't get filled up.
Yeah. People listening probably are thinking this is really interesting, but, how do I apply this? I mean, is this software that I can get somewhere? How is this going to help me?
Well, the software is available for people. So, for example, this is a model that we created using the software. This is for the stock market. So this is the Dow 30 back in 2019. And this uppermost point here, this is Boeing back before they had the problems with the Max. And this was Microsoft here. And this was Apple out here. And so what happened on this one side, there are 30 stocks in the Dow 30. And so these are the 30 points that represent their quantity going horizontally and their price going vertically. Now, very importantly, a 4D system doesn't have any negative, it has no negative components to it. So these are all positive directions. So positive quantities, positive prices. Now over here, you see what holds up the prices. On this axis, we're looking at the earnings per share. These are the same 30 points that are over there. So as the earnings per share go up, the sustainable price goes up. And in this direction here, we're looking at the return on assets. And as the return on assets go up, the price goes up. And so stocks that are over this line may be overpriced, or there may be other features in place. So for example, back in 2019, Boeing, again, before they had the problems with the Max, they had a backlog of 8 years there. And so the market was rewarding the fact that they had all this extra built up demand for their product. But products below this might be undervalued. Now you might add some other features in here that actually modulate this plane of best fit, which again, for your math nerds, is known as a hyperplane. And that's what we do. We typically will jam 3 or 4 or 5 variables in this and start to modulate this up and down and see if we find stocks, or in case of your people, if they're doing real estate, find real estate properties that are undervalued. And then if our analysis points us to this over and over and over again, well, we would pick the device, either the stocks in this case, or the properties in the case of real estate that are being indicated as being undervalued.
How are you getting the real estate in there in the first place? Is there some sort of application that provides like available real estate in the area that, how just out of curiosity?
Well, yeah, I mean, we go off to the standard sites. Zillow, for example, has prices that you could get probably better answers if you looked in the county book of records if you wanted to see what something actually sold at. But Zillow posts the prices of things that closed. If you suppose that they're accurate, then you got some pretty accurate data in this. Then they also show the proposed prices. And you can see the difference between the proposed and the actual prices. But you start to fill this with existing price data. And then you start to neck down what the value of the property is. So I know, for example, I've listened to you speak before. You're in Montecito. One of the things we did for a class is we examined the value of real estate in Stratford, Connecticut. We were teaching a class to Sikorsky, to Montecito, of all places. And it turns out that in Stratford, the closer you are to the ocean, the more the house is worth, the more the square footage, the more it's worth, the bigger the lot. The newer the house, interestingly, the more it's worth. And the same thing that happens out in Montecito, but it turns out that the climate in Connecticut isn't as good as it is out where you live, and so people reward Montecito more for all the like features. And so what you do is you're jamming in local features, again, the square footage, proximity to the ocean, the lot size, and then you're jamming in global features like, well, what's the climate like?
Right.
And so you put all this stuff together, and then you come out with answers, and you just basically shake it and let it settle out. Then you can figure out the best places to place your money.
Oh, well, my house is on sale right now, so maybe you can help me with that. Well, fantastic. So the book is Hypernomics, Using Hidden Dimensions to Solve Unseen Problems. I'm assuming you can get that just about anywhere.
Yeah, it's on Amazon.
How about learning more about the actual software if people are interested in that?
Yeah, the software is called Hypernomica, and you can pick it up from our website. We would prefer that people ask for a class. We're going to start to form some classes on this. It's taken us a while to get the classes in order, but the classes and the book will teach you the fundamentals of hypernomics, and then the software actually allows you to take the fundamentals that you've learned and then push them through the software to come up with the answers that you might want to see for whatever project you might be pushing it towards.
Yeah. Anything else before we cut out that I'm missing?
Well, no, but if people want to reach me, they can reach me on my personal website, doughowarth.com, or they can go to the company website, which is hypernomics.com. That's hypernomics.com. And there's a lot of little vignettes that show how we've used it, from everything from real estate to valuing NFL wide receivers to how it impacts COVID. So
interesting. So it might be good for your fantasy football stuff as well, is what you're getting.
Yes.
Fantastic. Great. Thanks so much for being on the program.
Well, thank you, Dr. Joffrey. I really appreciate it. I really love your show. Thanks. It's been a big privilege to be on it. Thanks.
Thanks. We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. I think the big picture idea here is the more data, the better. And maybe that's true, because if you have some variables that are off, then you have more variables that are, that input is correct. Maybe you'll have a better result. I think basically that's sort of in a nutshell, that's what Hypernomics is, and there's software for it. So hopefully that was useful to you. And if anybody does end up using that software, let me know what you think. I do want to remind you again, because of the activity in our Accredited Investor Club, that there is a good chance for you in there. If you are interested and you're an accredited investor, we have some financially distressed assets coming through that I think make great opportunities, basically that are cash flowing, majorly discounted assets. They're cash flowing even in this high interest rate environment. And as I've said before, and as the Fed has said itself, rates are going to come down. And so a descending rate environment ultimately is going to, what it does is it increases asset prices. So you've basically got wind at your back. Great opportunities. And if you're an accredited investor, think about it. Join us. Go to Investor Club on wealthformula.com. That's it. All I have this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.